get those big accelerations like you saw in 1980 and 2011, we're going to see that again. And I think, again, it could be as close as a year and a half away. And silver go from $60 in November and $120 in February the next year. So in a 4-month time frame, it like doubles. You get those kind of moves, you got to be really careful about getting out. In other words, the bulls aren't winning and the bears aren't, kind of neutral, staying in a very small area between, a couple $100, $300, move up and down. So they're basically evenly matched. At some point, they won't be evenly matched. The bulls will win or the bears will win. I expect the bulls will win and will move up from that channel formation, probably up to a new high. Not immediately. I mean, all markets move up and down, but we'll probably be looking toward the $5,000 level.
In this market outlook, precious metals expert David Morgan outlines why silver and gold could be approaching one of the most explosive phases investors have seen in decades. He explains that the major accelerations witnessed in 1980 and 2011 weren't anomalies. They were signals of how quickly these markets can move once momentum takes over. According to the analysis, a similar surge may be much closer than many expect. Silver's price history shows that once it breaks out of consolidation, it can double within months. A move from $60 to $120 in just a 4-month window is entirely possible during a high momentum cycle. Right now, both bulls and bears appear evenly matched, keeping prices in a tight range. But that balance never lasts. Eventually, one side wins decisively, and the next time that happens, the breakout is likely to be upward. The long-term trajectory suggests that gold could also escape its channel formation and begin climbing toward the $5,000 level, supported by macroeconomic pressures and investor demand. This setup gives investors a rare chance to be early before the next major run begins. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
If you look, you can go back to gold. I wouldn't, but it's up to you. The peak in gold on the left side was much higher than gold on the right side. But in silver, they're matched. So they almost are identical.
Yeah,
so gold is actually telling us ahead of time that it needs to consolidate. It needs to take a breather. While silver was ready to challenge the all-time nominal high one more time and it failed, but that doesn't mean it's not going to consolidate like gold, which I believe it. And silver is starting outperform gold on the gold silver ratio. I mean, it wasn't that long ago we were over 100. Now we're in the 80s, which is not historically is still very high for the gold silver ratio, meaning silver's really not caught up and outperformed gold as much as I think it will in the future, but it's doing its job and it will, I think, continue to perform or outperform gold over the next series of months and years. I really am kind of a lone cowboy in the thought process that we have a 2-year market, 3 maybe at the most. Many think we've got a 10-year bull market. On fundamentals, I would agree with that. The reason I am one of the lone wolves that we only have a few years, because I'm pretty well convinced that we are going to see a new monetary system in short order. And that when that takes place, I think all bets are off. We don't know what gold and silver are going to do, especially if gold becomes part of the new monetary central bank digital currency or something along those lines, where we have a new system based on basically a cashless society with social credit scores and a bank account that you have to opt into. China is the new financial empire. You see what's going on with the amount of gold that China's imported. You use the adage that's corny but true: he who owns the gold makes the rules. China owns most of the gold. And you're seeing, well, what have they done? They've done a beta test for the world on new monetary. They already have a phone system that you use, chat at 10 cents, and everything that you do in the 400 million in the cities, you can't use cash. Everything's done by the phone. Well, that's the world system that's been done in China for a few years, and it's based on a social credit score and how well you obey the rules that are come from on high. And that's what we're pushed into. That's the idea that the banking elite want. These are international. They have no propensity to be aligned with any given philosophy politically. All they think about is money. And so it's right in front of our eyes. We take that the Fed is at a point of becoming more and more powerful. The power of the market is taking precedence. Because of that, we're going to see more and more distortions. I mean, look at what's happened with Japan and the carry. I mean, Japan interest rates have moved up. And they have, for the first time in a while as far as significantly impacting people's think about what do we do, because there's so many derivatives. I mean, I'm not a big fan of Buffett's, but I'm not against any. But, when he said that derivatives are an object of financial mass destruction or something along those lines, I probably misquoted him, but the idea of the financial mass destruction is absolutely correct. I mean, the flea on the tail of the dog wagging the market, and that's a problem. So you've got counterparty risk bank to bank, and we've already seen it in 2008. These banks, some are too big to fail, and some are really big and do fail.
Mm-hmm.
And in a systemic risk where you've got nation state playing with the U.S. bond market and maybe selling more than the Fed could buy. I couldn't say they could sell more than the Fed, but let me say it, they could sell more than the Fed could buy efficiently. In other words, there's such a huge sale, like sell everything, like in the movie Roller. Certainly the Fed could mitigate it, but the game would be over, because what it would say is we've given up on the U.S. dollar. Now that, in my view, will, I won't say never happen, highly unlikely, but we could get a system where the AI starts to sell off and it's more than normal, and then another bank jumps in and does the same thing, and all of a sudden you have a cascading effect that wasn't planned, it just happened due to the algorithm.
In this in-depth analysis, precious metals expert David Morgan breaks down why silver may be on the verge of a major outperformance cycle against gold. Current charts show a powerful setup. While gold appears to be taking a breather after reaching previous highs, silver has already proven its readiness to challenge its all-time levels. The gold-to-silver ratio, recently above 100 and now in the 80s, still sits far above historical norms, signaling that silver has significant room to outperform in the months ahead. The discussion highlights a crucial turning point in the monetary system. With global financial pressures intensifying, a transition to a new digital-based monetary structure may be closer than many expect. If a central bank digital currency emerges backed by gold or a similar asset, traditional markets could shift dramatically, forcing both gold and silver into entirely new valuation frameworks. Morgan also warns that rising systemic risks are creating distortions across global markets. From Japan's shifting interest rate landscape to the growing instability triggered by massive derivative positions, financial structures worldwide are showing signs of strain. Even unexpected algorithm-driven sell-offs could trigger cascading effects not seen since previous crises. Meanwhile, China's massive accumulation of gold and its already operational social credit-driven digital economy signal the emergence of a new financial power. Precious metals may become one of the last anchors of real value. Let's get into the interview.
The point is that if you believe in more or less the Elliott wave theory, and I'm not an Elliott guy, but there's 5 waves. There's 3 up and 2 down. So you got a wave up, and then a correction wave, another wave up, and a correction wave, and then the last wave, the 5th wave, is the maximum in price appreciation and the minimum in time duration. And that's where that adage that I got really from Jeff Christian of the PM Group, that 90% of the move comes in the last 10% of the time. That's the FOMO, fear, panic phase. And it's not just the metals, and that's what gives me more solidity to push and build my case. It happened in the stock market during the tech wreck of 2000, happened in the housing market in 2008 and 9. It's happened in commodities across the board. And so I expect it to exhibit what I would call standard market behavior, that markets accelerate at the end. And you can actually project what it's going to do. If you take the third wave up, is after the crash, it went down to 9 and up to 45. So it was a 5X. Usually the last leg up, the one we're talking about, how long is it going to last, double. So if it was a 5X, you do a 10X. Well, what was the bottom of the last wave? And that was during the illness scare in March of 2020, and it hit about 12. So if you multiply that by 10, you get $120. Now, if we're in a 10-year bull market, and I can't rule it out, I don't know the future, it would be more of a steady eddy kind of build and base, and the fundamentals get put into the price act. But I don't think we have that kind of a market. We've got a very emotional market. We got a very fear-driven market that's going to increase in fear because of non-trust of government currencies worldwide and untrust of the political class generally. Seeing the war efforts and what's going on basically in the budget deficit that everyone is now acknowledging in the financial arena in the public way, where basically we've seen Moody's downgrade the U.S. Treasury market from little a. In other words, they've downgraded it slightly. And anyone that knows anything about math knows that this federal deficit cannot be unwound. The only way to really do it is by a reset of some type. And there are several ideas about how that might occur.
This powerful breakdown, market analyst David Morgan explains why silver may be entering the most explosive phase of its long-term bull cycle. Using the broader principles behind Elliott wave theory, not as a strict roadmap, but as a useful framework, he outlines how major markets often save their most dramatic moves for the very end. Historically, the fifth wave delivers the biggest price surge in the shortest amount of time, a pattern seen in tech stocks in 2000, the housing market in 2008, and multiple commodity runs across decades. When silver collapsed to around $12 during the 2020 global scare, and then surged to $45, it completed a classic third wave move. If the final leg historically doubles the magnitude of that run, the math points toward a long-term target in the $120 range. But Morgan warns that this market may not follow the slow, smooth accumulation of a multi-decade bull cycle. Instead, growing distrust in global governments, accelerating deficits, geopolitical tensions, and the steady erosion of confidence in fiat currencies could push investors into metals with increasing urgency. With credit downgrades and fiscal realities impossible to ignore, fear-driven markets tend to move violently and fast. If history repeats, silver's final wave could arrive far sooner than most expect. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.